This is video 10 of 12. The chapter 21 variances section of the chapter by chapter review of the primary study guide on pages 16 to 17 of the primary study guide, or the chapter by chapter review. For this chapter, you want to know whether a variance is favorable or unfavorable. Know that you prefer maximum income, so you want lower expenses than expected, higher revenues than expected. Lower expenses than expected would be favorable. Higher revenues than expected would be favorable. Vice versa. Interpret variances. You will want to pay attention to the type of variance. So if it's a price variance, you're looking for differences in price paid. If it's a quantity variance, you're looking for differences in quantities used. You will want to be able to interpret favorability. It is favorable if I use less or spend less than expected. Unfavorable if I use more or spend more than expected. You want to know how to calculate the variances given those formulas that you will have for the price variances, quantity variances, and potentially a total cost variance. And you will want to be able to designate favorability. On these, I do not anticipate giving you ones that require you to convert your standard price, standard quantity, actual quantity to some other terms other than the terms given you in the problem. So that is a little less complex than what you had on exam 3. You also want to know how to make revisions and updates for the flexible budget report. So update variable costs. To do that, you need a variable cost per unit times the new updated number of units. Fixed costs should not require a change. There should be no change between any level of units. Okay, determine whether favorable or unfavorable. My actual revenues were less than expected. My revenues fell lower than expected. That would be unfavorable. My actual revenues were higher than expected. That would be a good surprise. That would be favorable. Actual expenses were less than expected. So expenses, it cost me less than expected. That would be a good surprise. That would be favorable. Actual expenses were higher than expected, so I paid more than I thought. Unfavorable. Actual income is less than expected. That's not a good surprise. That's a bad surprise. That would be unfavorable. Actual income was higher than I expected. That is a good surprise. That would be favorable. Okay, now we have a price variance. So it's a difference in the price paid for direct materials. It's direct material variance was $1,000 favorable. So the price paid, if it's favorable, was less than expected. A direct labor quantity so if it's a quantity variance, it's about a difference in the quantity used of direct labor hours. If it's unfavorable, I used more than expected. I was less efficient than I'd hoped. What is direct materials price variance? ABC purchase, so I need all these inputs first. ABC actually purchased 92 yards of direct materials. That's probably going to be actual quantity for $10 per yard, so actual price. There's standard, so standard information calls for 100 yards, so it's standard quantity at a standard price of $8. So my actual price was $10 per yard. My standard price was $8 per yard. My actual quantity was 92 yards. My standard quantity, 100 yards. My total actual cost, 92 times 10, $920. My total standard cost, 8 times 100, be 800. I need my price variance first. So actual price minus standard price of 8 times the actual quantity of 92 yards. $184. My actual price of $10 is greater than my standard price of 8, so it cost more than expected. I paid a higher price than expected. That would be unfavorable. 184, unfavorable. My quantity variance using the same inputs, actual quantity minus standard quantity of 100 yards times the standard price of $8 per yard. Take the absolute value, that's 8 yards times $8 per yard. $64. As to favorability, my actual quantity, 92 yards, is less than my standard quantity of 100 yards. So I used less than expected. That is good news. That would be favorable. If I wanted to do the total cost variance, 184 unfavorable, minus 64 favorable, more than unfavorable, so 120 unfavorable. I could have also taken 920 minus 800. 120 actual cost was higher than standard cost, so unfavorable. Either way, 120 unfavorable, that seems to work out and check out. Either way. ABC predicted production of 2,000 units, and at that level, they predicted fixed cost of 6,000, total variable cost of 8. They actually produced 2,100 units. What would the flexible budget report for fixed and variable costs at that actual production level? So I see an increase in units here. The fixed costs should not change. They should still be $6,000. My variable costs, though, do change, so I need to get variable cost per unit first. At 2,000 units, I'd estimated they were going to be $8,000 total, divided by 2,000 units represented. So it's at a rate of $4 per unit. If I have 2,100 units instead at $4 per unit, that is total variable cost of $8,400. Instead, I could have had, as in this problem, 5,000 units that I need to update for actual production to 4,000 units. That is a decrease in units, so I expect to see a decrease in variable cost. My fixed cost should not change. They should still be at 15,000. My variable cost would change though. Total variable cost at 5,000 units was 25,000 divided by the 5,000 units that represented. That is $5 per unit. 4,000 units at $5 per unit gives me total variable cost of 20,000. That is it for video 10. We'll pick back up with video 11 at the top of page 18.